We've lived in turbulent times, especially in the financial sector. A lot of investors lost money. A number of companies were closed by regulators such as the Bank of Ghana and the SEC. And investors have lost money by investing in the financial markets. Indeed, when you invest, the expectation is to earn some returns. Okay, but investing also comes with risk. Some of these risks are manageable, others you cannot manage. I'd like to say that risk is everywhere dense. Okay, you can find risk everywhere you go. Even in our daily lives, risk is everywhere. But what we can do is to try to reduce risk and to manage what? Risk when we invest. Is that okay? Let me give you an analogy that I think will bring this clearer home. So when you sit in a car, okay, is there any guarantee that you get to your destination? There isn't. Is that okay? But there are safety measures that are put in cars to protect you, even in the event of an accident. Okay, so for example, you are asked to put on your seat belt. That is a risk mitigation measure. Okay, so when you are investing you need to look for ways to reduce risk or to mitigate what? Risk. Again, people don't understand that risk drives return. Okay, when I say risk drives return, what actually determines the returns you receive when you invest is the kind of risk that you take. Okay, so if you take impossible risk, then you are going to get impossible what? Returns. And those are returns that will likely not materialize. Is that okay? If you take too much risk when you're investing, if you're investing in vehicles that promise you 12% a month, 15% a month, that is outrageous. Nobody can really generate such returns for you with guarantee. Okay? And in situations or cases like that, you are likely to lose what? Your investments. Okay, so when you are investing, you shouldn't look for extreme returns, because if you do, then you are asking for extreme what? Risk. Okay, if you are looking for extreme returns, then you are also asking for extreme risk. And if you go in for extreme risk, you may lose all your money that you had invested. Okay, so basically that is about risk and returns. Now, because risk drives returns, when we are investing, the natural thing to do then is to try to minimize what? Risk. Or to try to mitigate what? Risk. Okay, so what are some of the measures you can use to mitigate risk? One is risk avoidance. Don't take any risk at all. But in this life, that is also something that you really cannot afford to do. Okay, there are people who say, oh, I won't take a plane. I don't want to fly. I'm scared of traveling. But you may be in your house, and this happened, I think, a few years ago at 37, and a plane can come and injure you. Okay, so avoiding risk is also not a very good option to take. Okay, so for example, if you are investing and you want to avoid risk, then you don't really put your money in risky vehicles, or you don't put your money in instruments that promise or give high returns. In such a case, you could, for example, put your money in a bank account where the risk is minimal or where the risk is what? Is low. Okay, so that is risk avoidance. The next strategy is what we call risk anticipation. And that is wise to do because we know that risk will occur, we know that risk will happen. So what you can do is to anticipate or plan for the risk so that when the risk materializes, it doesn't put you in an uncomfortable situation. Okay, so when you are investing, one of the risk mitigation strategies is to have what we call an emergency fund. Basically, this fund allows you to invest in instruments like treasury bills, okay? So low risk, equivalently the returns are also low, but your money is more or less guaranteed. Okay, you're not likely to lose this money. Okay, so one, you can have an emergency fund. Another risk mitigation measure is having life insurance. Okay, so, well, if you're a daredevil, maybe you don't want to insure, okay? But the essence of having life insurance is that, for example, if you pass on prematurely, then there's some money there for your dependents. Okay, so that's also a risk mitigation measure. And usually in a very good or optimal portfolio, you need some level of insurance in that portfolio. Okay, so one, is good to have an emergency fund. Two, is good to have what? Life insurance, okay? That helps to, in a way, put some shock absorbers into your investment strategy. Then next is what we call risk transfer. Okay, so if you can't absorb the risk, there may be parties who are better able to take on this risk. Okay, so again, one way to transfer risk is to use insurance. There are also more complicated vehicles, like what we call derivatives. Okay, so for example, if you are scared that the stock market will crash, you can buy a put insurance. That, in essence, gives you protection against a stock market crash. Okay, so another way to manage risk is to transfer risk to a third party who is better able to manage what? That risk. The final strategy I'll discuss is what we call risk reduction. Okay, and with risk reduction, what you do is that in investing, you're trying to diversify your portfolio, i.e., in layman language, don't put all your eggs into what? One basket, because if you do, what may happen? The basket may fall, break, and you may lose all your eggs. Okay, so don't put all your eggs in one basket. To bring it home when you're investing, it means that you should spread your investments across various asset classes. So you can buy treasury instruments, you can buy treasury bills. Okay, treasury bills are still treasury instruments. You can buy equity instruments. And there are other categories of investments that you could buy, like private equity, hedge funds, etc. A number of these are not yet available in Ghana. But try to diversify across instruments, so buy treasury instruments, buy equity instruments. Try to diversify across sectors. Again, I like to tell people that I don't like to time the market. I wish I had perfect foresight that I can tell that, oh, today maybe this sector will do well or that company will do well. But the honest truth is that we don't. Okay, and in the absence of perfect foresight, it makes sense to diversify. If you don't know which sector will be the star sector, let's say this year or next year, then maybe spread all your eggs across the different sectors. That's a sensible strategy to undertake. Or you're not sure of interest rate directions. Okay, some people want to bet on the interest rate. If interest rates are increasing, you want to do short-term instruments. If interest rates are reducing, you want to do long-term instruments to lock in the interest rate. But again, we don't have perfect foresight. We don't know what the interest rate will be tomorrow or in 6 months' time, okay? And therefore, in a scenario like this, it makes sense to, again, diversify. So put part of your money in the short-term end of the market, and also put part of your money in the long-term end of the market. Okay, so these are some of the risk mitigation strategies. Now, what should investors do after the financial sector cleanup? Okay, so I've already alluded to one, don't chase returns. Okay, because if you are chasing returns, you are chasing risk. Because risk drives what? Returns. Okay, so don't chase abnormal returns. What returns will we classify as abnormal? For example, 10% a month, I think guaranteed is abnormal. 12% a month guaranteed, I think is abnormal. Okay, currently, if you buy treasury instruments, they are going between 12%, 13%. Okay, for debt instruments, that's understandable. Okay, that is not like 120% a year. Or if you are doing the equity market, I would say that the average return probably you could get is about 20% a year. So between 12, 20% are normal returns. These are returns that also compensate you for what? Inflation. Beyond that, I think you should be careful. Of course, the equity markets in some years can do 50%. Okay, that's the beauty of equity. Okay, but if somebody is guaranteeing you 50% a year, 100% a year, you should flee for your life. Okay, again, when you are going to invest, ask relevant questions. What are you going to invest my money in? How does the manager manage risk? Okay, how can I get access to information about my investments? These are important questions to ask. Again, check if the institution is licensed. I'm sure Paul will speak more about this. Check if the institution is licensed by the SEC. Again, check if the institution has issues with the regulator. So I went to the website of SEC and I realized that they had categorized companies into let me say, buckets or color schemes. So they're gold. If you have a gold color, it means they don't have any issue with you. If you have a red color, it means they have issues with the company. Okay, so if the company you want to invest in has a red sign or red color, it means you should be careful in investing with these companies. Again, check the qualifications of the management of the investment company and also their board. Okay, that sends a signal. If the board has highly qualified people, and these people usually want to protect their integrity and their reputation. So it's not likely that these guys will mess up your investments. So check the qualifications and the experience. This is extremely important. The qualification and experience of the managers and board members of the fund manager you want to invest in. Also check their corporate governance. I guess this may be a bit complicated for the normal investor. How do you know that the board is well governed? Okay, but at least maybe you could speak to a friend or an investment professional who can tell you that, oh, given the board characteristics of this company, I don't think that they are well managed. Okay, so I know that this point may be a bit beyond the reach of the ordinary investor, but at least you can read something about how the firm is governed or how its board is constructed. Finally, maybe historical performance may give you a clue. So how have their returns been in the past? And like we always say, don't just focus on returns. What has been the risk of their returns as well? Again, in this respect, you may need a professional to advise you because you could calculate the standard deviation of their returns, etc., but that is a bit complicated for the normal or ordinary investor. So check the returns, and also you could get advice as to the kind of risk that the manager is taking. In essence, you can tell that by how its returns deviate from a benchmark. Okay, how its returns differ from a benchmark. So check the returns as well as the risk. Maybe in that direction, there was something that I proposed as market-based solutions. Okay, maybe consulting firms could look at coming out regularly with a ranking for mutual funds in Ghana that takes into consideration their risk-adjusted returns. So not just the return, but also the risks the manager took to achieve those returns. I think that would be very exciting, okay? And that will make it easy for the ordinary investor to check the ranking of a fund that they want to invest in. For fund managers, what should they do? They need to rebuild trust, okay? A lot of trust has been lost. And in the financial space, trust is the most important currency. If you lose trust, everything comes crumbling down. Okay, so trust is the most important currency in the financial space. So fund managers need to rebuild trust. They need to hold their officers to higher levels of accountability and ethical governance. Okay, what I mean by ethical governance is that you don't just do what is legal, but you need to do what is right. Okay, so ethical standards are a bit higher than legal standards. Then fund managers also need to invest on behalf of their clients and invest in the interest of their clients. So they need to reduce agency problems. The decisions they take should be in the interest of their clients. And then as much as possible, they should provide the necessary information that investors would need. In terms of the regulator, I think I'll just skip my slides on that because Paul will say a lot about that. Okay, so as an academic, when I was preparing for this program, I decided to launch a very small survey. I had a number of my students fill it. So at this stage, I think I'd like to acknowledge the MSc Development Finance class, Corporate Governance, Finance, and Investment. They filled the survey. All of them filled the survey for me. And a number of my other students who filled the survey. In all, I had about 222 responses or respondents. So the first question I asked is that, did you lose money during the financial sector cleanup? Majority of them said no. About 36% said yes. Actually, if you lost money, I don't think it's a shame to say that you did. I also lost some money in the cleanup, and I'm still waiting for my refund. Okay, so it's not a shame to say you lost. So about the majority said they didn't anyway. They didn't lose funds. Then again, I asked them, so if you lost funds, will you invest after the cleanup? The news is not so comforting. The majority said they haven't invested after. Okay, after the cleanup. And if they have invested, what convinced them to invest? So a number of responses came out. They want to earn more income because they are knowledgeable in finance and investment. They invested in safe institutions, in their opinion. They believe the financial institution is secured. They want to create an emergency fund. They want to increase their money. They think that there's more confidence in the financial sector after the cleanup. So I think that's very good news for the regulators. Then a number of them said that they did risk-free instruments. For those who have lost money, majority said they haven't received a refund yet. Those who haven't received a refund are not more confident in investing in the financial sector. So refunds per se haven't given investors more confidence to invest. Same thing for those who haven't received a refund, they are not confident in investing. And the last question I asked was that if you have excess funds, where will you invest these funds? I think the responses were quite eye-opening. So number one, 53% of the respondents said they'll do treasury bills. So they are going for safety. I guess because of the turbulence that has occurred in the financial markets. Then treasury bonds, I had 17.5% indicating they'll do treasury bonds. Mutual funds, so good news for the fund managers, 22%. Cryptocurrency, I know the regulator has some concerns about that, but it's 22%. Surprisingly, a lot of people wanted to invest in land, which is a real asset, not a financial security. About 37% wanted to invest in land, and about 28% wanted to invest in buying their own houses. And the stock exchange, not so great news. Only 7.9% of the respondents indicated that they wanted to buy shares on the GSE.